The second type of business organization is a partnership. A partnership is owned by two or more people. There can be hundreds of owners in a partnership, and they each own a different percentage. You can have two, or you can have 100, or some number in between. The advantages are there are not just a single owner who's responsible for the entire business. There are more than one owner, so two or more owners. More capital is available because we're combining the capital of multiple people. They are relatively easy to start, and income is taxed once as personal income. The partnership income for a partnership runs through each partner's individual tax returns. The disadvantages, of course, are also that unlimited liability. That unlimited liability where your personal assets are required to cover any business debt. So much like a sole proprietorship, partnerships also have unlimited liability. There are two types of partnerships: general partnerships and limited partnerships. In a limited partnership, some of the partners um, aren't as involved in the daily running of the business. They could just be an investment partner or someone who is contributing capital to the business but has zero interest in managing the business. So that's a type of limited partnership. Partnerships can be a combination of general partners and limited partners. Some other disadvantages are the partnership dissolves when one partner dies or wishes to sell. New partnerships have to be created when owners change. So it is difficult to transfer ownership because we have to create new legal documentation. Because also we should really spell out the rights and duties of partners, because if we don't have everything legally recorded on paper, many partnerships are started just as two friends who get together and decide to go into business together. However, this can have disadvantages if you don't have everything legally recorded as to who gets what, because as the partnership gets larger, those lines and requirements get less defined. And partners have gotten into fights and sued each other over different things that weren't included in partnership agreements. So partnership agreements, legal partnership agreements are very important. And then the next entity we're going to talk about is a corporation. So corporation is considered a person, a legal person distinct from its owners and a resident of the state in which it is incorporated in. The advantages are limited liability. So the owners are not personally responsible for the business debt. The corporation itself is responsible, and once the corporation's assets are exhausted, people cannot go after any owner's personal assets. So that is an advantage. Another advantage is that it's unlimited life. It's not linked to the life of any one person. There's a separation of ownership and management. So owners buy stock in a corporation and own part of the equity in a corporation, and the management is voted into power or hired into power by the board of directors. Transfer of ownership is easy, just requires the selling of stock, and it's easier to raise capital. Disadvantages are with that separation of ownership and management, we can create agency problems, meaning that the management and might not always act in the best interest of the owners. And this creates a problem where the shareholders want one thing and the managers want another thing, and they disagree. We also have a disadvantage of double taxation. Income is taxed at the corporate rate, and then dividends are taxed at the personal rate. dividends paid are not tax deductible to a corporation. So there is this double taxation that corporations are subjected to. International corporate forms. So we have different corporate forms that feature public ownership and limited liability within different countries. So we have some examples of German companies, United Kingdom companies, companies from the Netherlands, Italy, Sweden, and France. They are all corporate forms of organization. They just have different names. For example, the public limited company, a joint stock company, or a company with limited liability. Next, we're going to talk about what are our goals of financial management. What should be the goal of a corporation or even a partnership or a sole proprietorship? What should it just be one goal to maximize profit? And if the only goal is to maximize profit, could that mean we make decisions that hurt the company in the long run? And to maximize profit when? Only this year, maximize profit every year. So we have to look at what is actually the underlying goal. Minimize costs, and can we minimize costs that to the point that it actually makes us lose profit or market share? For example, if we really minimize costs in, if we're looking at a manufacturing company, if we minimize costs in production, that might mean bringing in lower cost materials or lower quality materials, which then eventually could lead to a loss of market share as we anger loyal customers because the quality of our product has changed. Is it instead of maximizing profit and minimizing cost, is it to maximize the current value per share of the company's existing stock? Maximizing the market value of the existing owner's equity? So these are all different things that we look at as what is the goal of financial management. Maybe it's a combination of all of those things. If we maximize a profit and our market share, we're going to be maximizing the market value and the current value per share of our existing stock. People generally buy stock because it is an investment and they hope to make more money in the future from it. In that case, we need the market value of the stock to increase to earn that investment. Does this mean we should do anything and everything to maximize owner wealth, such as outsourcing, offshoring, Enron, corporate support of charities? So each one of these things can benefit or cause disadvantages to an organization. Let's talk about outsourcing for one. Outsourcing can be a cost-saving measure. It can also be an opportunity for us to hire expertise that we don't have internally or get products that we don't have the technology or the manufacturing capability to create. There can be benefits to outsourcing. There can be disadvantages also. When we outsource, we lose control of the products. Another thing is offshoring. Offshoring is somewhat similar to outsourcing in that we send certain components of our organization to another country to be taken care of. If that's part of our manufacturing process, then what happens when we have a global pandemic and all transport and trade is disrupted? Then we start having disruptions in our supply chain. Enron. If you haven't heard of Enron, Enron was a corporation that in their desire to maximize their market share and their profit and their owner wealth, did a lot of questionable accounting practices, now illegal accounting practices, and committed a lot of fraud and ended up going completely bankrupt in just a matter of days. And people lost a lot of money, and Enron's one of the main reasons that we now have the Sarbanes-Oxley Act. Should we support charities, support communities, be good citizens within where we're operating? The Sarbanes-Oxley Act of 2002 was driven by multiple corporate scandals, Enron being the most recent before the Sarbanes-Oxley Act was created. At the time, Enron was the largest fraud ever done by a corporation. Now, of course, in 2008, we have frauds that were bigger than Enron's fraud, but we'll talk about those in later chapters. The creation of the Sarbanes-Oxley Act was intended to strengthen protection against accounting fraud and financial malpractice. The driving force between the SOX Act was to make sure that the public could trust the financial accounting information that was being generated by corporations. There are a lot of rules and regulations behind this act about how accounting and financial statements should be presented to the public for companies that trade stock within the US. The compliance for the Sarbanes-Oxley Act is very costly, and some organizations have either decided to go public outside of the US, for example, listing on the London Stock Exchange or the Tokyo Stock Exchange instead of the New York Stock Exchange, or to go private or go dark. Private companies do not have to follow the regulations that the Sarbanes-Oxley Act covers. So if a company decides to purchase back all of their stock from the marketplace and to no longer sell stock and be a privately held company, that term is sometimes called going dark because they're not required to publicly release their financial statements. Another thing discussed in chapter 1 is the agency problem or the agency relationship. So in an agency, a principal hires an agent to represent its interests. One of the examples from the textbook is if we hire someone to sell our car for us, or we hire someone to sell our house for us. We want them to work for us and get us the best price that they can. But how that contract is set up depends on whether or not they actually work to benefit themselves more or to benefit us more. In a corporation, stockholders are the principals, hire managers or agents to run the company. So stockholders elect the board of directors for a corporation. The board of directors is then responsible for hiring the CEO, the CFO, the managers that run the company. We can have a conflict of interest between the principal and the agent. So, such as, are managers working in the best interest of the shareholders, or are they operating in the best interest of themselves? So we can create this conflict of interest, which is an agency problem between the principal and the agent. Do managers always act in the best interest of shareholders? That depends on multiple things. One is the managerial compensation. If we use stock as part of a manager's compensation, the managers are going to be incentivized to make sure that that stock has the best value possible and is increasing in value. Therefore, they're more inclined to work in the shareholders' interest. We also want to be good managers so that we don't have a threat of takeover, because that does happen within companies. Control of the firm ultimately rests with the shareholders, and shareholders can vote to overthrow the board or overthrow the management of company. We can also buy more stock within the company. That's called a leverage takeover, sometimes a hostile takeover, where you own enough stock in the company that you're able to force decisions or force your way onto a board. And we're going to talk about these things in more depth. So everything that's covered in chapter 1, we're going to talk about in much more depth in later chapters. When we look at the cash flows between the firm and the financial markets, so we have two primary markets, the secondary market and a primary market. So cash flows to the firm from the primary market. This is when the firm issues securities or stocks to raise cash. So the firm gets the money when those stocks are very first sold on the primary market. Then the firm invests all of that cash in doing their business, and they can use what money they make from their business to pay dividends out to their owners. So this is just an example of how cash flows between the firm and the financial market. We're going to talk more about cash flows and stocks listing on the primary market, what's required to list on the primary market in later chapters. So we have primary markets and secondary markets. Primary markets are where the firm sells out to the public for the very first time. Secondary markets are where people who own stock trade or sell stock with other people who own or want to own stock. There are two different kinds of secondary markets, a dealer market and an auction market. Dealer markets are often called over-the-counter or OTC markets. Most trading takes place over-the-counter and OTC markets. Auction markets have physical locations such as a Wall Street, and they require someone to do the transaction for you. So the primary purpose of an auction market is to match those who wish to sell with those who wish to buy. In a dealer market, stocks and long-term debts, trading takes place over the counter, and you use a dealer to buy for you or broker. The two main OTC markets in the United States are the New York Stock Exchange, the NYSE, and NASDAQ, which stands for National Association of Securities Dealers Automated Quotations System, but normally called NASDAQ. There are also international, Tokyo Stock Exchange and London Stock Exchange being the most well-known international examples. That is the end of chapter 1.